All right, well, give me a thumbs up if you can hear me. All right, very good. Good evening, everyone. Thank you for joining us. Welcome to Crypto for the Masses. That's Crypto for the Masses with a question mark, a financial planner's perspective. My name is Mike Dunne. I'm a certified financial planner here at Cereus Financial Advisors, sitting in my office in beautiful downtown Franklin Lakes, New Jersey. So I have quite a number of slides to try to get through over the course of the next hour and still leave time for questions. There's some background information on me, which are included in the slides, and we'll be sending out slides to all of you. So I'm not going to dwell on my background at the moment, other than to point out that my colleague, David Haas, who is the president and owner of Cereus Financial Advisors and also a certified financial planner like me, has joined us as well, and David will be manning the chat. So as I go through the presentation, as you come up with questions, I'd ask that you hold them to the end, post them in the chat, and David can read them to me, and hopefully we'll have a chance to get through all the questions you might have. And with that, let's get started. Okay, very generally, the presentation tonight is going to follow this outline. Why crypto and why might it matter to us? I'll attempt to explain digital assets and blockchain technology. I've got some examples that hopefully I've simplified enough that even I can explain them. And then we'll talk about and explore different ways to invest in digital assets and blockchain technology, including some discussion of the benefits and pitfalls of each of those methods. But before we launch into it, here are a couple of quotes to ponder. We always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. Don't let yourself be lulled into inaction. That's from Bill Gates. Warren Buffett, writing in a 1986 shareholder letter to the shareholders of Berkshire Hathaway, explained, "We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." And finally, blockchain is a remarkable cryptographic achievement, and the ability to create something that is not duplicable in the digital world has enormous value. And that was from Eric Schmidt, the former CEO of Google. And by the way, I believe there's some debate as to whether he said blockchain is the remarkable achievement or Bitcoin is the remarkable achievement. But for our purposes tonight, I think they can be considered synonymous, at least for the purpose of this quote. So my own journey into crypto, my first peek into the rabbit hole kind of went in this progression. I thought it was tulip bulbs. And by that, I'm referring to financial mania from the 1600s, where people famously bid up the price of tulip bulbs in Holland, only to see them collapse when everybody realized that they're just tulip bulbs, causing losses of fortunes and lots of displeasure, among other things. And then I started evolving and began to think, well, maybe it's like lottery tickets. Occasionally I'll buy a ticket in the large jackpot Powerball or Mega Millions, but typically my lottery tickets wind up in the recycling bin. And then I attended a webinar given by Morgan Creek Capital Management. They're an asset management firm based in North Carolina. The chief investment officer used to manage the endowments of Notre Dame and then University of North Carolina, Chapel Hill. And as you can see, the premise of his presentation back then was #GetOffZero. In other words, if you don't have any exposure to Bitcoin or blockchain technology, you can't afford not to have exposure to it any longer. And he used in particular the diagram on the right, showing that at that time he believed that the world had only seen the tip of what could be a very large iceberg representing the potential for crypto and blockchain technology, including citing some pretty fantastical predictions like the World Economic Forum predicting that by 2027, 10% of global GDP is likely to be stored on blockchain platforms. Okay, so I thought maybe I better pay attention and see what this is all about. And during the webinar, the presenter started to show graphs, including some like this one here. So this is a chart that shows the rate of growth in number of users. The white line shows the rate of growth in the number of internet users from the beginning of the internet in 1992 through 2006, and comparing that with a younger but growing rate of use among crypto users. It's the orange line that you see here with the dotted line paralleling the white line but above it. With some interesting quotes that came along with it. The author of this particular piece, which he posted on Twitter, started at the point where started measuring the rate of, and comparing the rate of growth after each had started with their first 5 million users. So obviously it didn't start at the same time since the internet came before crypto. But after the first 5 years of each, beginning with the first 5 million users, by year 6, after they started measuring, crypto had 295 million participants and the internet had 119 million. Crypto is growing at 137% a year, while the internet grew at 76%. As the author said, this is the fastest adoption of technology the world has ever seen. And that's quite a statement. And it implies that by 2030, according to the author, that crypto and blockchain could become the dominant source of owning, transferring, and recording value and contractual terms globally. Those are quite some statements, especially at the time I had no exposure to crypto. I was trying to figure out what it was, and here's someone, knowledgeable people, saying this is going to take over the world. And indeed, if we look at spending globally on development of blockchain, it's grown and is continuing to grow quite astronomically. Beginning in 2017, as you see on the left here, worldwide spending on blockchain solutions was about $1 billion. Just 3 years later, it had tripled to $3 billion. And by 2025, 3 years from now, and only 5 years from that last measurement, spending on blockchain is predicted to reach $40 billion, more than 13 times what it was in 2020. And by 2030, some predict blockchain technology will deliver over 3 trillion in economic value. And nearly 30% of consumer products and manufacturing industries now use blockchain. So all of that sounded kind of intimidating. Is it really going to take over the world? And I thought one way to kind of get comfortable or to try to break it down into perhaps things that I can understand a little bit better, a little bit more easily, was to take the advice of some knowledgeable people in the industry who said, well, the problem of the word cryptocurrency can be kind of intimidating. As the comedian John Oliver, the host of Last Week Tonight on HBO, once said, cryptocurrency sounds like everything we don't know about computers combined with everything we don't know about finance. Pretty intimidating. And it was suggested to me instead that we think in terms of digital assets, or in other words, crypto assets, or just for short, crypto. Take the currency out of the equation. And perhaps a way to think about it, instead of wondering whether or not it's going to take over the world and I don't even know what it's about, a way to conceptualize it may be to think, well, think of it as a new way of transferring value over the internet, or new software that enables the transferring of value over the internet. And my opinion, it may be helpful to think of it instead as perhaps not taking over the world or replacing what we're all used to in terms of traditional currencies, but to watch digital assets grow up and exist alongside what we know in traditional finance today. And when you think about it, I think we've been kind of moving in this direction in smaller steps anyway. Beginning with paper currencies and checks on the left, we moved to credit cards, a plastic representation overlaid upon our world of paper currencies and checks. And our younger generations have introduced us to Venmo, an electronic version. overlaid upon our traditional world of paper currencies and checks. And from there, perhaps it's not as much of a stretch to think that we can go from electronic Venmo-type payments to the idea of a virtual transfer of value. So our old US dollar and our good old US dollar used to be backed by gold. And there was an SNL skit that explained this quite nicely and succinctly. About a year ago, when Elon Musk hosted the show, there was a skit they called Cowboy Standoff. And some of the characters were plotting to get back at the bad guys by figuring out how they could steal their gold. Elon Musk, who's among the troop of cowboys, says, well, instead of that, why don't we create a new currency? And Beck Bennett says, that ain't how money works. Money is a golden rock that we dig out of the ground. Then we hope no one kills us before we trade it for green paper. It's a perfect system. Well, we kind of changed that perfect system during the Nixon administration. Now our currency, the dollar, as well as most major currencies around the world, aren't backed by gold or silver or other commodities like that anymore. They're considered to be fiat currencies. Fiat being a decree by our respective governments that such currency constitutes legal tender. And SpongeBob learned the lesson of credit cards in 2006 in an episode where his boss sent him out on an errand to buy something with the boss's credit card. He approaches the cashier and says, I'd like to buy this piece of plastic, that piece of plastic, with this piece of plastic. And he's amazed when it works, and he leaves the store scratching his head saying, that's it? I'll never understand the workings of high finance. And now I've got a series of diagrams that I hope will show how our sort of existing paper and plastic, if I can call it that, financial system works, and then compare it with what seems to be taking shape in the virtual world. So in our current system, we have banks, and you can think of banks in this particular case as separate networks or separate databases. Bank A knows its customers, knows its depositors, knows the people and companies that it's lent money to. Bank B knows its own network and database of customers, who are the depositors, who they've lent money to. Bank B controls its database. Bank A controls their database. They don't share information, so Bank B doesn't know anything about Bank A's customers, and vice versa. Bank A doesn't know anything about Bank B's customers. Well, let's say we have some theoretical people, Alice, who's a customer of Bank A, and Bob, who's a customer of Bank B. Alice wants to send $100 to Bob. They don't live in the same place, so it's not convenient for her to give Bob cash. She's not going to mail cash. Bob doesn't take credit cards, so she realizes she's got to send Bob a check. So she drops a check in the mail to Bob. A few days later, it arrives. Bob goes to the bank and presents the check and says, I'd like my $100, please. Bank B says, hold on a second. And behind the scenes, they go back to Bank A. They send the check back and say, this is one of your customers. Please remit $100. Bank A goes and takes a look at Alice's account and makes sure that she has at least $100 in her account. If she had $100 and she wrote a check to somebody else already, she has nothing left. Bank A can't honor the check. But fortunately, Alice does have the money. And this is Bank A trying to avoid the what we'd call the double spending problem. Alice has to have good funds, and Bank A verifies that before they remit funds to Bank B. And once that happens, then Bank B allows Bob to withdraw $100. And as you know, it takes perhaps a day or a couple of days for that to happen. So if instead, moving into the electronic version of things, Alice and Bob both have accounts on Venmo. Well, that's easy. Alice can just, with a couple of clicks on her smartphone, send $100 over the Venmo network to Bob. That's great, a lot faster. You can think of Venmo also as its own separate private database. Venmo doesn't know Bank B's customers, Bank B doesn't know Venmo's customers. Same thing between Bank A and Venmo. Venmo doesn't share their database of customers with Bank A and vice versa. So when Bob goes to take $100 out of Venmo by saying, okay, I want to transfer this money from my Venmo account to my bank account, that takes a couple of days, typically. As you know, you can't just have the money instantly move from your Venmo account to your bank account. So to try to solve some of these issues, perhaps in terms of timing and in terms of cost, developers came up with what is essentially a decentralized network, moving from what we know on the left to what a decentralized network looks like on the right. There is no central authority controlling all of the participants in that network. And the blueprint for this was written in a white paper that's available for free on the internet by someone or someones named Satoshi Nakamoto. And this white paper became the blueprint for the Bitcoin blockchain. This is an excerpt, just a snapshot of the first page, the first paragraph. And in summary, the abstract, it says a purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. A little bit further on, well, let's skip that. I think it gets a little technical, but nonetheless, this was kind of a revolution in the way of thinking about sending cash from one party to another. So in the next several slides, I will try to describe how a transaction works on the decentralized network or the blockchain. So here is a look at or a diagram that attempts to explain how a blockchain would work with all network participants rather than a central authority able to see everything that is in the database on the blockchain. So you can look at the various circles connected as participants in the network. You can see Alice on the lower left in the green circle and Bob on the middle right in the green circle as well. And you see these representations, these orange blocks connected by arrows. That represents blocks of data sequenced together in, you guessed it, a blockchain. Every participant in the network can see all of the data that's in all of those blocks in the network. So instead of sending $100 to Bob in what we would think of as perhaps the usual way, Alice proposes instead to send $100 worth of Bitcoin to Bob over the Bitcoin network. So she creates a message, and this is for, let's assume Bob and Alice are tech savvy. She sends a message out proposing a transaction. That message can be seen by everyone on the network. And in particular, in this next diagram, there are a couple of nodes or circles highlighted in blue who we'll refer to as Bitcoin miners. Miners compete for the opportunity to propose a new block of transactions to the network. And they compete by trying to be the fastest to solve a complicated cryptographic puzzle for the right to propose that transaction. So you can see that the miner on the left of the diagram in the blue dot has proposed a new block of transactions that's represented by that purple block. It's a new block on that miner's version of the database that the others haven't yet added to their database. This miner happens to have been the first one to solve that cryptographic puzzle and propose the new block of transactions that includes Alice's transaction to update to the network. All of the other participants, including other miners on the network, then technologically go back and check that miner's work to make sure it's correct and validate the transactions that are included in that block. If it all checks out, and this is something that happens with software fairly quickly, the new block of transactions is accepted, and the database is shared with all participants. So you see that all participants on this network have added this new purple block of transactions. And in effect, what has happened is that $100 worth of Bitcoin, by virtue of that processing, has moved from Alice to Bob. Practically speaking, that whole process these days takes on average about 10 minutes. Requires a lot of electricity and a lot of computing power, as you've probably heard about, and I'll talk about that hopefully in a little bit. So among the breakthroughs that industry watchers and technology watchers find, there are three that I'll touch on over the course of the next couple of slides. This slide is courtesy of a money management firm called Bitwise Asset Management. And in their view, this is breakthrough number one, the ability to move financial goods over the internet. Blockchain databases allow financial goods to settle essentially instantly. Instantly is a bit of an exaggeration, but for a transaction to settle in 10 minutes, where it might otherwise take, for example, stocks to settle in 2 days, bank wires, especially international bank wires, 2 to 4 days, even electronic bill pay out of our bank accounts. It's like writing a check and mailing it essentially. Takes 1 to 5 days. So blockchains not only reduce that time, but you can bank effectively on the blockchain 24 hours a day, 7 days a week, 365 days a year, and the fees are pretty minuscule. So we talked about Bitcoin miners a couple of minutes ago, and here is a summary of what they're all about. Excuse me. So, as I mentioned, miners compete to solve a complicated cryptographic puzzle to propose a block of transactions to the network. They compete because they're paid a reward. And this proposing of a new block and then having the other miners and participants of the network validate that block or check their work is known as proof of work. They're paid a reward for completing the necessary calculations required to enter a new block onto the chain. The reward miners get is an incentive motivating people to assist in the primary purpose of mining, which is to legitimize and monitor transactions, just ensuring their validity. Mining is how new coins are brought into circulation or minted, at least in the case of Bitcoin. And in a public network, anyone with access to a computer, you or I, can mine, resulting in a decentralized cryptocurrency. Now, theoretically, you or I can participate, and it's possible. Practically speaking, there are large companies with blocks of computers like the block of computers that you see at a Bitcoin mining facility pictured here that are going to have a significant advantage over me with my Mac laptop, for example. So what I've hoped to illustrate with the previous example are the attributes and benefits of blockchain, which is sometimes referred to as distributed ledger technology, or DLT. It's a shared database. Everyone on the network can see it. Think how different that is from a bank where a central authority, bank management, gets to see what's in the database, and customers, everyone else who participates in the network, doesn't get to see what's on the network, as well as people outside the network who don't get to see it. It's transparent. So the contents of each block can be viewed by anyone on the network. The data the data has integrity. It's been validated and maintained by all participants on the network. It's immutable and permanent. No single participant can go in and change historical data without having to redo the whole blockchain effectively. It's secure, and that reduces the risk of fraud because it's not just one person maintaining the database, it's all participants in the network. And it's efficient. There's a reduced cost to transact, and you don't have to go through extra costs to share information. Everyone's got it, got a copy of the database on their computer who participates in the network. So because the blockchain is transparent and we can see everything that's happened on the blockchain to date, and by the way, just thinking back to Alice's transaction with Bob, the reason why she was able to send that blockchain and have that transaction be valid is because everyone on the blockchain could see that Alice owns sufficient Bitcoin, $100 worth of Bitcoin, to be able to send to Bob. So it's not a question of somebody needing to go back and check Alice's account. There's a record of Alice having obtained that Bitcoin at some time in the past that's available on the network. So things are more traceable than we thought. There used to be horrible headlines about, criminals who can abscond with people's Bitcoin and never be found again. And that changed when we started to see some headlines like this. You'll recall a famous ransomware incident where the FBI was able to recover Bitcoins that were paid to a foreign ransomware group by a large U.S. Natural gas pipeline company. And perhaps a bit more recently, not only was Bitcoin recovered, but people were arrested for having stolen Bitcoin. The trick in this case, and the trick with any of these cases, is although all the movements of Bitcoin are visible on the blockchain, identifying the owners of all the wallets on the blockchain is perhaps not as clear. These are a couple of famous cases where they found the owners of the wallets that had received the stolen Bitcoin or the ransomware paid in Bitcoin. And I like this quote on the bottom right from a former federal prosecutor who said that the blockchain enables digital breadcrumbs effectively. There's a trail that law enforcement can follow rather nicely. So thinking back to our example about essentially skirting around the banks, going from our traditional way of doing things to a decentralized network where people can just send money and transfer money and engage in transactions directly with each other, it's obvious that banks, among others, are companies, and perhaps the larger financial institution industry is at risk of being disrupted. So here is a recent survey of where some household name companies stand in terms of adoption of blockchain. Some have it in production on the far right, some are in development, and then others are still, trying it out or in research. And you'll notice among some of the household names are the big banks. So they're not going to sit by and allow themselves to be disrupted without figuring out how they can adapt to what may be perhaps a new way of doing things in the future. And although this slide mentions some statistics that are probably a couple of months old at this point, it was a fairly decent snapshot to show how far things have come in terms of growth of the blockchain. So if we can think of it in terms of measuring how big the blockchain technology has gotten by measuring the value of the digital assets that circulate on those blockchains, the global crypto market cap, or global market value of all digital assets, at the time of this slide was about 1.9 trillion US dollars. Compare that with global stock market and global bond markets, each over $100 trillion. So crypto has grown, but it's still tiny compared to the financial markets that we know, 1 to 2% perhaps of the size of those markets. At the time, Bitcoin had a market cap or total market value of over 800 billion. I'll show you in a couple of slides that is now more like 560 billion with some recent price volatility during this year. At that time, there were only a few publicly traded companies that were larger than the total value of all Bitcoin in circulation. There are probably a few more now that Bitcoin's value has gone down more recently. And just to put things in sort of historical perspective, the total market cap of Bitcoins in circulation is roughly the size of the global equity market when the equity market was measured in 1979. So give or take 40 years or so, the equity market has increased since then by about 50 times. So digital assets have come a long way, still have a long way to go to and I'm not sure the word is compete, but to arrive at a similar scale to what we're used to in terms of the global equity and bond markets. And I'm pretty sure that we all, if you even pay casual attention to the news, have heard that Bitcoin mining has an energy problem, in particular an energy consumption problem. So all of that work to solve cryptographic puzzles, that's really where most of the computing power and electricity and resources are devoted in terms of Bitcoin mining. From what I understand, verifying the transactions in the block is an easy part of that. It's solving the cryptographic puzzle first. That's the hard part. Uses an awful lot of energy. So for somebody that little, you sure use an awful lot of energy, Mr. Bitcoin. The graph on the left shows at least, and these I'm not going to sugarcoat or justify, but I believe and I expect that things will improve. This graph on the left is a survey by the Bitcoin Mining Council that looked at the mix of energy, sources of energy used in Bitcoin mining activity. The two green bars represent the amount of sustainable power as a percentage of the total power that Bitcoin miners use, showing that the industry is becoming greener. And it compares that with the energy mix, and I'm not sure this is a really great comparison, but this was the chart I found, the energy mix of major countries around the world. So you'll see some European companies like European countries with energy mixes slanted toward renewables and sustainables, close to 50% of their energy mix, and coming down to the US around 30% and on down to other countries. So comparatively speaking, Bitcoin's energy usage in terms of where it's coming from is getting greener, and I would expect that would continue. The chart on the right shows Bitcoin compared to other industries in terms of annual energy use as measured in terawatt hours. Now, this might be a little hard to see, but Bitcoin is the first bar on the left, 79 terawatt hours. You can kind of barely see it on the graph there. Compare that with the transport industries. So the third, fourth, and fifth blue bars, air transport, sea transport, and land transport, all consuming a significantly larger amount of energy. The healthcare industry in pink, consuming a considerably larger amount of energy. And in particular, the building sector on the far right in gray. These are all residential and non-residential buildings energy usage. And if you add the construction sector to that, it's a smaller gray bar, just two over from that. Comparatively speaking, we could say that Bitcoin uses a whole lot less energy than those industries. That's not an attempt to justify or say, see, it isn't that bad, because we know they're still using a lot of energy. I think what's helped is China's banning of Bitcoin, which I think happened last year. A lot of miners located in China were using coal as their source of energy, which was, the cheapest form of energy in China. With China's ban, the miners no longer were allowed to mine or use any energy, and in particular, that reduced the coal as a percentage of the energy mix of the Bitcoin mining industry. We've still got a way to go. If you think about the incentives for Bitcoin miners, their costs are computing power, space to keep their computers, and electricity. So to the extent that renewable and sustainable energy, and the difference between those two being nuclear, are cheaper than conventional fossil fuel forms of energy, the industry will gravitate toward that over time. So why are there so many different digital assets or currencies or cryptocurrencies? Even though I don't like using the currency word, it's one that is used pretty widely, just, nevertheless. This is a snapshot I took from Monday, and a couple of slides ago, we talked about the total market cap of crypto assets or digital assets being 1.9 trillion. Well, it's more like 1.3 trillion now, as you see M cap on the upper left of this, if you can make that out. And then this is simply a listing of the top 15 largest digital assets, with Bitcoin and Ethereum, the two largest, making up about 65% of the value of all digital assets out there. So if you notice on the bottom of this picture, there are 23 more pages of digital assets listed, which I didn't go into, but I'm not even sure that would capture all of them. So why are there so many? We'll talk about Bitcoin and Ethereum in a minute, but conceptually speaking, it might help to think about different crypto assets and different blockchains as being like different software companies, each invented and developed to accomplish different things. So the Bitcoin network being a proof of work, decentralized peer-to-peer payment system. We'll talk a little bit more about other attributes of Bitcoin in a slide or two. The symbol on the right, it represents Ethereum. Ethereum is a platform on which many other applications are developed. And I'll go through those also in another slide or two. And just as examples, Chainlink is another blockchain, which I think is developing technology to enable different blockchains to communicate with each other. And Uniswap happens to be a digital exchange. So if you think of Coinbase, a place where you can log in and buy and sell different cryptocurrencies, Uniswap happens without humans and enables you to do the same thing. It's a concept called smart contracts, which I'll talk about in a slide or two. So rather than replacing things, Bitcoin is increasingly being thought of as being a potential digital gold. Breakthrough number 2, according to Bitwise Asset Management, is the creation of digital property rights, digital scarcity, something that's unique and can't be duplicated on the internet. You can own Bitcoin without any trusted third party like a bank saying that you own it. The network consensus will verify that you own it. Bitcoin's got a finite supply. So comparable to gold, gold doesn't have a finite supply, but the overall supply of gold increases very slowly over time. From where we stand now, 19 million out of the total possible supply of Bitcoin has already been mined and minted and is in circulation. Every 10 minutes or so, 900 new Bitcoins are minted per day. The miner's reward is reduced as part of the way the network was set up. Right now, if a miner solves a cryptographic puzzle and gets the chance to propose a new block of transactions to the blockchain, their reward is 6.25 Bitcoin. So even at a lower price these days of close to $30,000, that's a fairly significant amount of money. And I looked up online that the average cost to mine a Bitcoin is somewhere between $7,000 and $11,000. So there's quite an incentive for miners to continue mining and earning a lucrative reward. Well, the way the reward system is set up is that every 4 years, the amount of the reward goes down by 50%. So in 2020, the reward was set at 6.25 Bitcoin. 4 years from then, in 2024, that reward will be cut in half to 3.125 Bitcoin. 2028, that reward will be cut in half, and so on and so on, in a process that people refer to as either halving or, in crypto speak, halvening, which didn't used to be a word. All the way out to the point where the last Bitcoin according to the way the network was set up, is scheduled to be minted in the year 2140. There's another concept of digital scarcity, which I'm not really going to touch too much on tonight. It's another world entirely, called NFTs, or non-fungible tokens. And you may have heard about different forms of digital art that are created that are unique, and although they can be replicated, there's a digital receipt for the true original. And that may have implications down the road for a whole host of things, like artists with music royalties and things like that. So it could be a benefit to the creators of digital content. Ethereum, as I mentioned, is considered more of a platform on which other things are developed. These other things being generally thought of as programmable money, or DeFi, which is short for decentralized finance. Crypto assets, being native to the internet, can be programmed like software. And the software can be designed to replicate a lot of high-cost financial functions more cheaply. Many of those financial functions currently involve humans. The world of DeFi is already quite far along in development. There are billions of dollars in digital asset loans, money market style funds, exchanges like the Uniswap exchange that I mentioned earlier, and other applications. And this idea of programmable money is what Bitwise Asset Management considers to be the third big breakthrough enabled by the digital asset and blockchain. I don't want to call it a revolution, but development, let's say. Then there are altcoins, which explains all those other pages, listings of coins, which we didn't really get into. Altcoin generally is a term that refers to all other digital assets besides Bitcoin. I've talked to people who cynically refer to altcoins by another name that begins with SH and rhymes with Bitcoin. I don't think all altcoins will wind up like that, but there are some doubters. And with thousands out there, it's hard to imagine that all of them are going to survive. And they have different characteristics. Perhaps unlike the Bitcoin blockchain and some others, some of these blockchains and digital assets may not be as decentralized. So it remains to be seen which ones will be the survivors over time. Two that I do want to talk about, if I can fairly quickly, are stable coins and central bank digital currencies. So stable coins have been developed to perhaps deal with some of the volatility that we see in Bitcoin and Ethereum and tons of other digital assets. So they've been developed with the idea that the value of the asset is pegged to something else that we know of as being more stable, like a dollar. So we have two different types, collateralized stablecoin. The two best known of those are called Tether and USD coin, or USDC. The value of those are pegged to $1. So each digital asset that they issue, because it's collateralized, they claim they hold $1 of actual traditional assets to support, whether it's US dollar cash, treasury bills, other bonds with perhaps or other financial assets that have a fair value that enables the total value to support the stability of USD or Tether at $1 per asset. And then we had the unfortunate example just earlier this month of algorithmic stablecoins, where they try to set up an arbitrage type mechanism, or a mechanism that where they control the supply in order to force the price of the digital asset back to $1. Unfortunately, this very large and recent experiment didn't work, and it was a case involving UST, which is called Terra, and its companion coin Luna. Luna at one time grew to be the 10th largest digital asset in circulation, and the mechanism, the market, it was very transparent, which is the nice thing about digital currencies, but that transparency meant that the market could see the shortcomings in how it was put together, and a combination of forces worked to attack the value of UST and Luna. And the organization that was set up to back the value of these currencies actually went and bought other digital assets to help support the value, among which included Bitcoin. So with the total collapse in value, it affected some of the assets held to support the value of the UST and Luna, including Bitcoin. So not only do we have the Fed's increasing of interest rates and inflation to deal with in terms of causing asset prices in both the digital and traditional worlds to go down, we have specific reasons within the crypto world that have also caused perhaps a further decline in prices. So the photo that you see on the right is a photo of a tattoo that a crypto, well, he may have been a millionaire or a billionaire before he entered the crypto world, but a guy named Mike Novogratz, who is the CEO of a crypto company called Galaxy Digital. He was a big fan of Luna, and his company made a venture investment in Luna, and he, in a perhaps a very bullish moment earlier this year, went out and got a Luna tattoo. And he's since been very public about his mistake and the failure of Luna, saying that it was an attempt at creating an algorithmic stablecoin that would live in a digital world. Unfortunately, it was a big idea that failed. And my tattoo will be a constant reminder that venture investing requires humility. Last thing on this page, central bank digital currencies. You can think of these as a digital version of fiat. So a digital dollar, the most famous example, is already being tested by China, the digital yuan or renminbi, that has been circulated among the population in test cases. The US is not that far along, but it's studying the possibility of whether or not it might work for us. All right, I see that we're at 8:16, so I'm going to try to move through this fairly quickly. We're now at the last part of the presentation and looking at ways to invest in digital assets and blockchain. Essentially, I think of this in two categories. You can get direct exposure by investing directly in the digital assets themselves, or in futures contracts on commodity exchanges, where you can buy or sell contracts on Bitcoin and Ethereum to exchange at some point at a future price. Or you can hire an investment manager to go out and invest in these digital assets directly for you, and they'll set up an investment management account for you like they would for stocks and bonds. It's not something that you can trade every day, but it's something that you can call up and say, I'm going to send you more money, or I'm not happy with your results, send it back to me. And there's indirect exposure, where essentially you can trade digital assets in securities form. So there are publicly traded trusts available. Essentially, you can think of these as big pots of digital assets. So the largest one the largest one that's out there is a big pot of Bitcoin. There's another of Ethereum. There are actually a couple of them of Bitcoin, and one that invests in the largest 10 by market cap. And more are coming. There are crypto equities. You can buy Bitcoin mining companies, the stocks of Bitcoin mining companies. Other companies that are involved in blockchain technology. IBM is famously integrating blockchain into a lot of what they do. So in a sense, you could think of IBM as in part a crypto equity. It's not a pure play because they're involved in other businesses that don't involve blockchain, but nevertheless, it's a significant piece and it's growing of their business. Or you can invest in ETFs and mutual funds that invest in digital asset futures, or in some of the publicly traded trusts, or in crypto equities. And just to note, there have been many applications denied by the SEC, ETFs and mutual funds that want to invest in digital assets directly. I believe there are 2 still under consideration with decisions due in June or July. We don't know if the SEC is yet ready to smile on ETFs and mutual funds that can invest directly in digital assets. Perhaps because of some of the pitfalls that we'll talk about in the next few slides. All right, so this slide is a bit dated, admittedly, and doesn't take into account any of the market activity this year, which has been incredibly volatile. But for a period beginning January 1st of 2014 through June 30th of last year, a study was done trying to examine the effect of adding digital assets to a traditional portfolio of stocks and bonds, 60% stocks, 40% bonds. You can see some of the results here, generally implying that if you start with a base portfolio, the traditional portfolio on line 1, you can see the returns and volatility across the columns along the top line. And if you compare that with the same portfolio, but where you add a 1% weighting in a digital asset, or 2.5% weighting in a digital asset, or 5%. And just comparing returns in the first column, this was a favorable period for investing in digital assets, so returns are higher, both on an aggregate cumulative basis as well as on an annualized basis in the second column. You would think that the volatility would go up significantly in the third column, but the data shows otherwise, fairly stable. In Sharpe ratios, measures of risk-adjusted returns, the higher the Sharpe ratio, the more efficient, the better reward for the risk taken, seeming to imply that weightings in digital assets can only help a traditional portfolio. Well, then in February, I read Barron's and I came across this article. So you can see on the left side, the headline in the print version was "How Crypto Can Hurt a Balanced Portfolio." And it was contributed by an outside author, the Chief Investment Officer of International Wealth Management at Credit Suisse. And she agrees that digital assets provide some correlation benefit and diversification, and an excerpt that's just below where you see the article there. But she goes on to say on the lower right, higher allocations, meaning above 2% of a balanced portfolio, increase portfolio risks materially and alter the nature of the entire portfolio. That's why Credit Suisse doesn't include digital assets in its advised asset allocations. Well, I had the other study in mind on the previous slide when I saw this, and I wrote a letter to the editor, and they published it. They kind of shortened it. You can see at the end there, they say, my question is, which conclusion is correct? The study on the previous slide or this one? What I was really trying to ask was, this Credit Suisse author didn't really describe the methodology she used or the data that she studied. So I wanted them to compare notes. Credit Suisse effectively didn't show their work. Were they looking at the same data and considering things in the same way? In any case, the results so far this year seem to bear out what she says at the end of this first paragraph. However, volatility is what makes crypto assets challenging for investors. They're on the lower left. So benefits and pitfalls of investing in digital assets. I'm going to highlight a couple here. Volatility. It's a benefit and a shortcoming. Volatility on the upside has been sometimes astronomical. You don't mind participating in that when it's going up. However, you're not very happy when you see tremendous volatility on the downside, like we've been seeing more recently. It seems like in good times that crypto assets or digital assets provide more diversification and they're not as correlated to traditional assets. But lately, in the macro environment we're in, they seem to be trading like aggressive tech stocks and they're going down with everything else. Two things among pitfalls that I'll highlight in the next couple of slides: safety and security, and taxes. In terms of safety and security, if you want to invest in digital assets directly, you've got to make a couple of decisions and be comfortable with technology, potentially. Who is going to hold your digital assets and where you're going to hold them? Are you going to set up your own wallet or a sponsored wallet? If you're holding your own wallet, you better not use your private key. We've all seen headlines like the one on the right. Lost passwords lock millionaires out of their Bitcoin fortunes. Are you going to hold your crypto in a hot wallet, which is always connected to the internet and vulnerable to being hacked, or cold storage, which just means it's not connected to the internet, has nothing to do with cold temperatures, deep freezers, or northern climates? And recognize that you're dealing in a new world here. There's no FDIC insurance. There's no, like you have on your bank account, or SIPC insurance like you have on your brokerage accounts. If you're going to trade it, which exchanges are you going to use? There isn't a New York Stock Exchange where the closing price of Bitcoin was such and such. These exchanges operate all over the world. They're not uniform. They don't close, as I mentioned. They're open 24/7, 365. And if you open accounts with them, some might be better than others at having a help desk or customer service. If you decide to send crypto to an address on the blockchain, a digital asset to another address on the blockchain, you better get it right. If it goes to the wrong address, you may not be able to get it back. It could go to someone else's address that is legitimate. You may or may not get it back, or it may go to an address that doesn't exist. The blockchain doesn't correct that. And as mentioned, in general, when you're on the blockchain, there's no help desk and no customer service. Well, the BBC did publish an interesting article that people reported that they got some hackers to help them find the lost Bitcoin fortune. Taxes are a big issue. I know at least one of you is a tax professional among the audience tonight. And it's very important, if you hadn't considered this, to understand what you're getting into. Every time you sell or exchange a digital asset, it could be a taxable event. This is when we're talking about direct holdings of digital assets like Bitcoin and Ethereum. You pay someone, could be a taxable event. If you buy something with Bitcoin or Ethereum, Elon Musk, Tesla, they accept Bitcoin. You can buy a Tesla with it. That could be a taxable event. Might seem great. Hey, I paid $10,000 for a Bitcoin. It's now worth $100,000. I'm going to give it to Tesla, and they're going to give me a new car. Great. You owe taxes on $90,000 of gain for the appreciation in the price of Bitcoin. Well, I know. Instead of giving him Bitcoin, I'll trade it for Dogecoin. Elon likes Dogecoin too. When you exchange Bitcoin for Dogecoin, you'll receive $100,000 worth of Dogecoin. You'll have to pay tax on the gain of exchanging your Bitcoin for Dogecoin. If you trade crypto in and out a lot, like a day trader, taxable events each time. And it's up to you to keep meticulous records and report all of your crypto activity on your taxes. It's coming, but it's not there yet. Providers like Coinbase, Gemini, and others other exchanges and custodians, they're not yet required to keep track of all your activity and report it on Form 1099 to you and the IRS. So you think, well, okay, if they're not reporting it on 1099s, who's going to know? The IRS is asking a lot of questions, and I think you're only asking for trouble if you don't report. So please don't go into this with the idea that who's going to know and you won't be caught. Indirect exposure avoids some of these pitfalls. You're basically buying and selling securities. Companies that invest in digital assets can afford to pay for institutional grade security and service. And you can hold your securities in what we're used to, brokerage accounts. You'll get 1099s for all your activity. It's an easier way, perhaps, although the prices may not follow digital assets directly, they're pretty highly correlated and should move along with volatility in the underlying assets. In closing, some thoughts from Mike Novogratz, the millionaire who was among those who lost in the collapse of UST and Luna. It reinforces a few core tenets of investing, especially for crypto investing. Keep a diversified portfolio, take profits along the way, have a risk management framework, and understand that all investments happen in a macro framework. Reading the stories of retail investors who lost their savings in one investment is heart-wrenching, and it really is. A core tenet in the crypto belief system is equal access to markets, but it's important that less experienced market participants only risk what they're comfortable losing. As far as crypto and digital assets have come, it's still important to only be willing to risk what you're comfortable losing. He, Mike Novogratz, has often said that people should allocate no more than 1 to 5% of their assets to the space. So there we are, folks. I'm sorry to run over time. There was a lot of material to cover. I hope I've managed to explain, or at least partly explain, this new world of digital assets and blockchain that we're becoming acquainted with. And I'm happy in the remaining time to take some questions. I have time if you want to hang around for a little bit. If not, I'm happy to take up conversations with you separately. Please feel free to reach out to me at these at this email address or phone number, and I'll look forward to hearing from you.
Hey, Mike, that was really great. I know I learned a lot, and there was a lot of information packed in there. There are a couple of questions in the chat. Shelley asks, what about XRP? I have to say, I don't know what those letters are. Maybe you do.
Yes. XRP is otherwise known as Ripple. And I believe at one time it was the third largest crypto asset behind Bitcoin and Ethereum. The way that they issued their tokens was construed by the SEC to be a securities issuance and an unregulated issuance of securities. And it's currently, they're currently in court now with the SEC, debating or disputing that. I don't know if it'll wind up with a settlement, but Ripple is the company that developed XRP. It's supposed to facilitate international transfers of value, large international transfers of value. It's not a decentralized blockchain. Ripple, as a company, kind of controls most of the blockchain. Yet there was some utility, perhaps, to what they were offering, and they're hung up in court now. So the value of XRP has gone down quite a bit. We don't know how it's going to turn out. If they get a favorable court decision, XRP could recover in value, but how far, I don't know.
Okay, that's interesting. Michelle asks, how does one know how to evaluate the soundness of crypto? How can you tell what they invest in, for example?
Very good question. Perhaps one way is to, and this isn't foolproof, I tend to look at value, and there are others others who are knowledgeable in the industry who consider to be who consider user acceptance, and I think what follows along with that is market value of the digital assets themselves increasing. So increasing usage and value does have a lot to do with it. However, you have cases like Dogecoin, which, believe it or not, was started as a joke and is now the 10th largest by market value digital asset, and a companion coin called Shiba Inu, which is another type of dog coin, which I think is the 15th largest. It's difficult to understand what those blockchains are trying to accomplish and how unique they might be. So I suppose it's an evaluation of the blockchain. What is it trying to accomplish? Is it an improvement on anything else that's out there? And is it widely recognized to be an improvement in terms of the value of the assets? Complicated question. I might be tempted to tell you to talk to more knowledgeable people in the industry, or to perhaps rely on them rather than trying to invest in them directly.
Okay. I think Michelle might be typing a follow-up, but meanwhile, Gurmukh is asking, will we get the presentation slides? And the answer is yes.
Yes.
Although it might be next week before we send them out. So if you're gonna dabble, one thing that I heard is that it's very easy to use Coinbase, for instance. They're one of the largest exchanges, but they also charge pretty significantly high fees. So, what are some alternatives to using Coinbase?
There are alternatives. I'm not sure they're going to be much lower in cost. I happen to personally have a very small Coinbase account, and I agree with you, their transaction fees are very high. Although they're a backer of the USD coin, the $1 stable coin. So you can move that around all you want. They don't charge you for that. But if you're buying Bitcoin or Ethereum, you're paying a fairly high commission. I suppose competition is going to take its toll and reduce that. Gemini is another competing exchange that's fairly well known and is, I believe, also a regulated trust company in the state of New York. So one that is trying to attain, recognized stature as a banking institution. That talks to safety and stability, perhaps, but not necessarily transaction costs. I think it's competition over time that is probably going to reduce transaction costs in exchanging and buying and selling digital assets.
Okay. So Michelle has typed another question here. Can you separate the blockchain methodology from the coin, or does the blockchain speed feeding the coin's worth? I'm not quite sure. The blockchain speed defines the worth. I'm sorry, Michelle, not quite clear on what you're asking.
Yes,
For the
sorry,
second part of the question.
I'm not sure I followed that. But Michelle brings up an interesting point. Digital assets need blockchain. Blockchain doesn't necessarily need digital assets. So you can think of examples in what I'll call the private sector. IBM is setting up blockchain for applications with, say, their clients in the supply chain networks. There is incentive to share information, and it makes it cheaper and easier to transact and track activity on the supply chain. But it isn't necessarily, I don't know this for sure, but I don't believe it's incented by the awarding of crypto assets to participate on that blockchain. Let's see, what defines the worth of a digital currency? That's the $1 million question.
So Mike and I have had arguments about this. Well, discussion. Maybe it's not arguments. Discussion.
Do you want to give your opinion while we're at it, David?
Well, my personal opinion is that digital currencies that are fiat currencies, like any fiat currency, is purely about supply and demand. So the worth is based basically on demand. Now, the U.S. dollar, which is the big fiat currency, is demanded because we all get paid in dollars. We get to buy things in dollars. Oil is priced in dollars. So dollars are in continuous demand. So the question is, a currency like Bitcoin, what makes it in demand? If I go out and buy gold, at least I can make shiny jewelry out of it, or make paint out of it and paint my the dome of my building. But I can't do that with Bitcoin. I can't even put it in a little frame, on the wall.
Unless your frame is your computer monitor, and even then, we don't have a visual representation. People have made up this B kind of $ symbol, but Bitcoin doesn't really look like anything. It's just a virtual marker, perhaps, of value. So there's lots of theories on how to come up with the value of digital assets. They differ from methods of valuing traditional assets. So what's the value of a stock? Well, the stock is share and ownership of a company that does something to generate profit or loss. And you can estimate the cash flows that business will generate, how much of that will accrue to your shareholding, and determine a value. How much are you willing to pay to get a piece of to participate in the value creation by that business? There are some valuation theories out there about digital assets, and we're not talking about companies here, obviously. We're talking about a digital representation of value. It doesn't earn anything. It's not generating something to be sold necessarily. So people point to things like network effects. The value of the network is more valuable, and there are some theories of exponential growth. So a certain number of users on a network implies that the value of the network is some multiple of the number of users on the network, and I think that works on an increasing scale. Remains to be seen, ultimately, whether that works. Supply and demand is certainly part of it. So traditional methods can't be applied to digital assets because they aren't traditional things. One of the quotes that I didn't put in the beginning of the slides was, "What the most dangerous words in investing are, this time it's different." And I'd be tempted to suggest that in the digital asset world, we're not saying this time it's different, but this itself may be different. Ultimately, there is value to what blockchain technology brings to the table in terms of improvements and cost savings. Where that all winds up, is something that we're very much interested in following over the next several years.
Okay. So I guess Michelle asked a few more questions. And a couple of these are interesting. The government can print currency. How are the owners of coins prevented from releasing more?
In the case of Bitcoin, it is code. It is basically coded into the software, and it would take a majority of users on the network to, I suppose when the time comes, agree on whether or not to continue to reward miners beyond their supply beyond the ultimate circulation of 21 million. You can contrast that with, and this is not me giving a judgment necessarily, but you can contrast that with what the Fed and the Treasury have done. Printed money at extraordinary rates to help us get through a series of crises: the global financial crisis of 2008, the coronavirus pandemic. Now that they're taking it all back, it's easy money is going away, and it's having an effect on a lot of things. So I can speak to the Bitcoin network being a finite supply. Ethereum, the second largest crypto asset, does not have a finite supply. That's not programmed in. So utility, what you can do on Ethereum, I think, will determine ultimately what the value of the Ethereum digital asset will be. Why did Luna fail? Because it stopped being worth $1, effectively. People, in effect, did stop demanding it. In fact, they sold it in droves when they realized that they were basically standing in front of a freight train and they were going to get run over. And the freight train was the rest of the market, essentially selling.
I mean, I think an important point is that Luna was a stable coin. So it was pegged,
a stable coin, but not a collateralized stable coin.
Right. So it was pegged to the dollar, and they had a methodology for keeping it the same as the dollar. And these methodologies can be subject to failure. And this one failed, so it dropped below $1 and then kept dropping.
And even now, I think they're still trying to figure out ways to resurrect it, but there's an awful lot to resurrect if they want to try to bring it back as a viable digital asset. I don't know that many people are expecting that they'll be able to bring it back.
So whenever you have a peg in a currency and you peg it to another currency, you have to defend that peg because speculators are going to come in and try to break it. And that's true in the world currency markets as well. There are currencies that for a time were pegged to the dollar or pegged to the euro. And if there's not enough government firepower behind the peg, then the peg can fail. And that means that the currency will float, or they have to adjust the peg. It might be a defined change to the currency, but that has happened in the past. I can't think of a particular example, but it has definitely happened in the past.
Well, perhaps among the most famous examples is the so-called George Soros breaking the Bank of England, and that was Britain, I believe at the time, looking to stay within the currency bands that would enable them to comply with joining the EU or the euro currency mechanism.
Yeah, I vaguely remember something about that from business school. I think it was the snake in a pipe or something like that, where they were attempting to let the currency change, but just within guideposts.
Within a certain range, yes,
yeah,
yes. And they were not able to, or Soros was able to amass enough resources to apply selling pressure to the currency to make it fall outside those bands. And I suppose the Bank of England, who was charged with maintaining the value of the currency within that band, decided not to continue to keep trying to defend it. So it contrasts with the Hong Kong dollar, for example, which I understand and Hong Kong being a special administrative region of China still has its own currency. And that currency has been maintained within a band of approximately 7.7 or 7.8 to the US dollar. But what I've always understood about the Hong Kong dollar is that they hold the requisite amount of US dollar assets to keep that. So it's a much firmer peg than some of the other pegs we've been talking about. It's in effect a collateralized peg.
Okay. So I think we've run out of questions.
Okay. Well, thank you, everyone, if you're still with us, for joining us. I'm sorry to run over slightly, but I felt it was a lot of material and also found it hard to cut back on it because I felt the slides were there to help me illustrate what I wanted to illustrate. So hopefully I succeeded. In any case, thank you for your time. And I'll look forward to hearing from you if you've got further questions or if you'd like to chat further.
All right. Good night, everybody.
All right. Thanks very much. Take care.